And we really need silver. It's a very useful metal and that is likely to continue to go higher. We're probably going to go significantly higher. And I don't have a price target necessarily, but I think we're very, very far. I mean, we can see a triple in prices in the next 1 to 2 years.
Hey everyone, this is Elijah K. Johnson with the Miles Franklin Market Update. And back with us today is Tavi Costa, the portfolio manager at Crescat Capital. Tavi, thank you so much for joining us today.
Well, thanks for having me. Looking forward to this conversation and happy to be here.
One of the things I wanted to touch on at the beginning of this interview is what we're seeing with gold and silver prices. The last month or so, we've kind of been seeing a divergence. And we saw this a couple of weeks ago when we saw that big move in silver, I think on when it rose 10%, gold didn't budge that much. But looking more long term, we are seeing a divergence, it seems like. In the last month, silver is up over 7%. Gold is actually down over 2%. So what is your perspective on what's happening right now?
Well, it's pretty interesting. I think it has a lot to do with nominal rates and some of the movements towards the economy doing perhaps a little bit better and risk on assets improving as well. And maybe silver does have more of that aspect to it. But in my view, it goes to show the strength of the gold cycle. It's important to acknowledge when you are in a bull market for gold. And I strongly believe we just entered one. And the people that are really well rewarded, the investors that are really well rewarded, are the ones that really take advantage of the pullbacks in gold. Not the ones that buy it after a breakout or anything like that. No, the ones that really buy it at the 15, 20+% pullbacks that we have. We've had over 16 of those in the last bull market, if you consider the bull market starting from 2001 all the way back to 2011. So it's pretty important to see that one of them was in '08 when gold was down significantly, and some investors really took advantage of that and purchased gold at really cheap levels, and then were able to really in a very attractive situation, and all the way back to 2011. And I think it's similar today. It's time to usually the bull market starts with gold. The big allocators begin to really put money into gold. And when you start seeing a sustainable move on gold, the next step really is that you start seeing the capital or the risk curve. Investors go up on this risk curve and start looking for other sorts of assets that are linked to gold. And the first one that comes to your mind is silver, and the second one is platinum. And then you start going down to the miners, kind of like what Warren Buffett did and just sold his Barrick position. But going down to Newmont, and then Barrick, and then Kirkland, B2 Gold, and you keep going lower and lower. And so, as capital starts to flow into other parts of the industry, it is pretty interesting to see a very, very risky asset such as silver relative to gold being a more volatile asset relative to gold, holding up much better than gold. That goes to show this impressive move in silver, where I think we're just at the beginning of a cycle for gold and silver and miners. I mean, it's important to remember it's not only silver. I mean, the GDX actually underperformed gold in 2020. And this was a marvelous year for precious metals, where silver was up 50%. And so it's really interesting to see this types of moves. It goes to show how early we are in this cycle, and it's important to step back, look at the big picture, and continue to position yourself to the big move.
What do you think are some of the root causes of this divergence we're seeing? Because most of the time, gold and silver really trade in lockstep fashion, but now we're seeing silver rise more than gold and the ratio starting to fall.
Well, it has also to do with the disconnect of gold relative to other commodities. It's not just silver, but it's almost every commodity, including oil and copper, doing really well this year. I mean, oil is having its best year in 30 years, I published the other day. And copper as well is doing really, really well. Agricultural commodities having an incredible year, up 20% year over year. And so, there's a lot of other commodities that are disconnecting even from gold. And, I think gold usually leads the way. It's the commodity that really leads the commodity super cycle, in my view, and along with being a monetary asset and silver too. And then we start seeing more cyclical commodities following the way. it's clear to me that we're having inflows of capital towards hard assets. I think no one would really disagree. I mean, commodities in general just broke out from a 12-year resistance line. Now, answering your question specifically, I mean, nominal rates have been moving higher and higher, and so are inflation expectation too. But more recently, certainly, we saw nominal rates moving a bit faster than inflation expectation. That doesn't take away what the thesis really is. I mean, the Federal Reserve, if you step back and look again at the big picture, the Federal Reserve has to be suppressing interest rates going forward to allow the government to borrow on more and more debt. And what we're seeing here is a problem where nominal rates cannot move much higher than where they are right now, especially because of risky assets too. I mean, they're justified by those the huge multiples that we're seeing relative to fundamentals in the equity markets are justified by nominal rates. So at what point do we see a continuation of falling real rates again? And certainly we're seeing that in 5-year real rates, and not yet on the 10-year, at least as of late. Another thing that is having an impact on gold is a very big short bets on the dollar that are, I think that the dollar is still fundamentally stronger than other currencies out there. And so that is a little bit challenging from a positioning, from a trader perspective, is that I think when things get a little bit overcrowded here, is perhaps a time when you see a move to the other way. So I think that those are some of the reasons behind this move on gold. But again, it doesn't take away what the big thesis is going forward. I think fiscal stimulus and monetary stimulus at the size that we're seeing are here to stay. And this was an inflection point. The pandemic situation certainly was an inflection point for the markets and for the way that the economy is being led by, on the political environment, on policy members and so forth. So I think there's a lot of, very positive macro drivers for gold that will continue to be supportive of this move going forward. So we're very bullish still. And again, this is the time to take advantage of it and buy it 20% cheaper.
And where do you see this ratio between gold and silver falling?
Well, historically, I believe it's at about, at least it was over 50% above its historical number. And it's very possible, we can calculate it in different ways, especially from different ratios. But I think it's possible to see this falling as far as 20, as 30. This is it is pretty far from reality still. Again, it's when you think about this move from the old economy to the new economy, it feels like a lot of technologists forget that the highway to go from the old to the new economy really is commodities, and silver is a huge part of that, including copper too. Gold, yet not so much. It's more of a monetary metal, I would say, but certainly its industrial aspect to a silver, along with this green movement, along with this need for inflationary hedges, makes a lot of sense to be long silver today. Sub $30, I think, is the cheapest metal on earth, and I've said this a few times. And from a supply perspective, if it's hard to find gold, it's really hard to find silver as a byproduct as well. So we are really working a lot in terms of that in the exploration side of the industry, and we are fully aware of the difficulties of finding new discoveries of gold and silver. And this is going to have some major implications in the developments of whatever it is, the green movement or innovations and so forth. So to build a world that can be electrified as most want to are desiring these days, we really need silver, and so it's a very useful metal, and that is likely to continue to go higher. And I think that we're probably going to go significantly higher. And I don't have a price target necessarily, but I think we're very, very far. I mean, we can see a triple in prices in the next 1 to 2 years. And when you start thinking about the impact of that in prices of the miners and how they are going to be benefiting from their margins in general, I mean, it's going to be a really big move for them.
And why specifically do you see silver moving now? What is different about the next couple of years that you say silver could triple?
I think there's a lot of parts. I mean, the macro imbalances create the demand, number one. Number two, silver is not only cheap relative. I mean, it starts with gold. Gold is really cheap relative to money supply with the monetary base. It's cheap relative to equities. It's cheap relative to almost to fixed income. You name it. And so today you go and look for any asset that yields anything, and you can't find. The current earnings yield today for the S&P is about 1% higher than inflation expectation. It forces allocators to be looking for assets that will perhaps appreciate in price. And when you're looking for cheap assets that can have the potential of going higher in prices, commodities are really the way to be looking at. And then you have the commodities to equity ratio at a 50-year low. So it forces investors. And then when you think about this dependency of monetary and fiscal stimulus to continue to prop up equity markets and financial markets in general and the economy, you really start seeing that it is necessary to own something that protects you against the dilution of money and inflation. And, studying history, one of the most effective ways of being, benefiting from this sorts of imbalances in the macro world really are silver, along with gold. But silver really is one of the metals that appreciates a lot during inflationary environments, especially when real yields are falling. And this is exactly what we're seeing as the Federal Reserve is forced to continue to suppress rates, as I said before, and run the economy hot. So inflation expectation has been rising. Again, I showed a chart the other day. Inflation expectation follows commodities, to the dot. It's the same chart. In other words, as commodities begin to rise, hard assets rise, it becomes more inflationary. So you have the inflation expectation rising too. And the other thing that has been a huge difference from 2008 and post-global financial crisis is this wealth transfer from the government to the people that we're seeing that creates, again, another exacerbates this need for an inflationary or a hedge against inflation type of asset, which is silver. So it starts from there, and then you look at gold, and gold is cheap, as I said before, but silver is extremely cheap relative to gold. And then from there you go to the supply side of things, and you start seeing that silver was up 50% in 2020. That's an incredible year. Meanwhile, if you strip out a lot of the silver miners, which is not an easy task to do because a lot of the gold miners are involved with silver and vice versa, as you all know, what you find is that CapEx is down about 20%, and a year when silver is up 50%. So, this is a type of divergence that we haven't seen. Exploration budgets declining while you have silver and gold rising, the geological challenges of finding gold and silver, another thing to add to the table. And the situation that happened in 1919, I'm not sure if I shared that before, but 1919 during the Spanish flu, what we had was, post the World War I, the impact that it was is that raw materials in general became rare, and with that we had not a problem. Commodity prices began to rise, not because of the aggregate demand that was driving that, was really aggregate supply that was so constrained going forward that accelerated the prices of commodities and created another acceleration in inflation and actually caused equity markets to fall apart close to 20%. So when we hear the roaring 20s and all those ideas, well, before the roaring 20s, we had a decline in equity market, a very, very severe recession that was forgotten by a lot of people. So this is, for me, in a way, it's kind of similar. There's no way to pinpoint some time in history and say that we're seeing the same macro environment. But certainly, silver is as cheap as it gets as a metal. So I really think that it's, regardless of this move on cryptocurrencies and all that, it truly fits the macro environment, the electrification of the world and the supply issues is just very compelling to be long silver today.
And with respect to the inflationary environment you said that we were in your quarterly newsletter, you talked about how debt monetization is really now the primary way of funding the government. That's just kind of shocking. What does that mean for the dollar going forward?
Well, the dollar is in trouble just like any other fiat currency in the world, and so we're in a race to the bottom there. And the issue with the debt monetization is that, again, monetary stimulus is becoming a funding tool for the government, where you have money supply surging while fiscal deficits are getting worse and worse. M1 money supply up 45% year over year. I mean, you can go on and on. And basically, who is really funding this deficit is not only the Federal Reserve, but also U.S. banks that are being forced to buy more treasuries than they actually provide of loans for commercials, industrial loans, and even households. And that is the first time we're seeing such a large move. We've seen that throughout history, but not to the degree that we're seeing today, where U.S. Treasuries, the Federal Reserve and U.S. banks are taking close to 60+% of the issuance of treasuries since the beginning of the pandemic. So $4.5 trillion of debt issue since then. And the twin deficit is another problem, right? You have the current account issue that is also becoming worse and worse, along with the fiscal deficit. So there's so many reasons why the government is in trouble. And when you look at the ownership of treasuries today, what you find is that the ownership of foreigners is declining significantly, while the Federal Reserve is taking up, becoming the buyer of last resort. And so, those are important points. And this is not happening just in the U.S., right? You have this happening worldwide, where central bank assets are growing in levels that we've never seen in the past. And so, the thing that is different from other times in history, however, and you have to acknowledge that as a macro investor in general, is that the social impact and the economic impact of those policies today are having a very, very different consequences than they had back in '08. When I talk about this issue with the wealth transfer, it really is a problem. Not a problem, is something that is happening that is completely different that happened in '08, and that will create inflation, in my view. I'm happy to extend on that, but it's a dynamic that we have not seen in the past. And clearly the government is it's not as it used to be, where you're seeing just assets flying high with the monetary stimulus creating this environment. It's also the net worth of individuals that is improving over time too. And the link of the two, along with supply constraints, is what creates inflation, in my view. And I'm not sure the Federal Reserve is completely ignoring inflationary forces. In fact, they're saying that that's not an issue at all. Or perhaps transitory, but is it? I don't think it is, and it's going to be hard to hide this in the following months.
Now, one of the things you touched on that's really interesting is kind of the different environment that we've seen since '08. If you look at the Fed balance sheet, it's gone from 900 billion to over 7 trillion now. It's just unprecedented. It seems like everything is running on a different procedures in a sense. Everything, it seems like, is being propped up by money creation. And one of the things also you pointed out in the quarterly newsletter is it's actually having a positive effect on the lower 50%, which is really interesting, because it seems like goes against what a lot of people have been saying is like there's this transfer from the poor to the rich. But actually, over the last couple of years, we've been seeing the opposite. So if you could expand on that.
It's so difficult. I mean, when I wanted to deliver this message, I was trying to be very careful, because I don't want to step on anybody else's toes and say that we don't have inequality issues. We obviously do, but I feel like there is a lack. I don't know if it's on purpose to fit in the political agenda to say that inequality issues are getting worse, but actually they're slightly getting better. Obviously, there's so much still to be improved, but when you look at what happened in '08, when the bottom 50% lost close to 84% of their wealth back then, and so it did during the tech bust as well, about 23% or so. This time around, we saw the largest annual increase in the middle of I call it a depression, not even a recession. The largest increase in wealth by our net worth of the bottom 50% in history. If you look at the entire population, it was somewhere close to 13 or 12 trillion dollars of wealth created. And somebody's going to pay for this bill. There's a money party going on that I like to call that is being propped by the government and the Federal Reserve, and they cannot stop that party at all. And when you look at the U.S. bottom 50% in terms of their balance sheet and just look at liabilities versus assets ratio, it's falling, meaning they're getting stronger in their balance sheets. And what we hear usually is that income is going steadily throughout the years and actually going lower throughout the years as well, depending on what parts of the society you're referring to. And that is not wrong. The problem is that, what do you prefer, having a better income or a better net worth? Now, I'd much better, have a higher net worth than a better income personally. So what we're finding is that 85% of the U.S. bottom 50% owns basically their assets. So 85% of their assets is in real estate. So when you look at the net worth of the U.S. bottom 50%, again, their chart, the chart of that looks a lot like the chart of house prices. And so, it follows pretty much the same line. So house prices are doing what now recently? They're going up. So, it really feeds consumption. It feeds what we're seeing now recently, which is again, a money party going on. That is not to say that there's not inequality issues. Again, the ultra rich still owns about 31 or 32 trillion dollars of financial assets. That is 15 times what the entire bottom 50% owns. In other words, the 1% owns 15 times more of financial assets than the bottom 50%. Why? Because the ultra rich don't hold a lot of real estate. They hold financial assets. So that's the big difference here. And those assets are the ones that benefit from this political environment that we're seeing of money printing and so forth. So, those are the interesting parts. And even if you look at the lower classes net worth today relative to the higher classes, that ratio of net worth, you see that the lower classes are improving relative to the higher classes is in the last decade or so. Again, what I think that, coming from Brazil, I'm originally from Brazil, and seeing what bottom 50% are capable of doing in terms of consumer spending is that, they really overspend. In fact, I was in the mall the other day. There was a huge line of Louis Vuitton. Why? It's sort of interesting to see that kind of a trend recently. Cars, used cars prices are going higher, not only because of demand, but also because of supply constraints. So you're kind of mixing the two. If you see where I'm coming from, you're kind of mixing the two. It's a supply issue of goods in general, at the same time as you're having this wealth transfer from the government to the people. And what we're likely to see is a surge and I think that the equity market is already front running this. It's exactly why you're seeing Russell 2000 being where it is, the small caps and the large caps and you name it, everything is up. And I think that that's all kind of reflecting this wealth transfer. And there's some commodities that are not reflecting that yet. I remember seeing this research at the beginning of the year, looking at oil, it's still sub $50 a barrel. For me, this was, just a steal. I still think that there is a case for oil to even double in the following in this year. So so we're very bullish in commodities in general, as we think that investors will continue to look for hard assets to protect against inflation. But this wealth transfer it's a very apolitical view, just looking at the data, and it drives us to this conclusion of we're likely to not only see supply issues, but perhaps even an aggregate demand kind of boost that is being probably caused by the lower classes, especially. So that is very interesting. I think it's sort of a unique analysis in the macro environment.
So one question I have is do you think the increase in net worth for the bottom 50% is more caused by the money creation that has been going on? Or do you think it could just be, since COVID, people haven't been going out to eat as much, they haven't been going out and spending as much, so they're just saving more money? What is your perspective on what is really the root cause of this?
Yeah, well, savings went up a lot and then in decline again significantly, but it's still, today's levels is way above historical average. Is that telling you that they're going to continue to save, or they're probably going to spend money? I think that's a more important question is what is the year-over-year change going forward, not what it was in the past. And I think that it's that they're probably going to spend money. And so, you give money, again, if you research emerging markets, the major reason why emerging markets have a big problem with inflation is, number one, because of their currencies that are very weak. Number two, because of the political parties and political leadership that tends to weaken the currencies. But most important is the lack of knowledge about the financial, being financially savvy in general. That I think it creates the overspent situation where the bottom 50% of a place like Turkey, Brazil, is much worse than the bottom 50% of Brazil, of the U.S. So, you find a behavior of consumption that is much more aggressive than we see in the U.S. And so, that's kind of what we're likely to see here is a more aggressive consumption by the bottom 50%. But yeah, you're right. It's the money printing that is, unfortunately, deflationist. It's not unfortunately. I mean, it really is a point of view, I guess. But look. Deflation is like to say that we're not having, that this is again '08. Money printing doesn't create inflation. Why? Because of the aging demographics that we have. We have a lot of debt. We have a problem where the technological advancements are creating deflationary forces. And so there are reasons why, deflation is here to stay as well. And I don't want to ignore some of those important ones. Now, comparing the policies, the pair of the combination of fiscal and monetary stimulus today and saying that the social and economic impact are being the same as we saw back in '08 is just absurd, and so I think that will be the big difference. And it's difficult to see you give money to the lower classes and they're not going to spend, they're actually going to save. Have you ever seen that throughout history? So I have not. So it's somebody's going to have to pay for this. I'm not saying the economy is doing great, by no means. What we saw was literally a transfer from the government to the people, and the government's taking the burden. Look at the debt. Look at the deficit. And the problem is the Federal Reserve and the government cannot allow and can't afford to let the party stop. So, that's why we're going to probably continue to see those policies going forward. We have the political environment for that right now with the Democratic sweep. We have Bernie Sanders in the game. We have Elizabeth Warren. We have Janet Yellen. We have the Fed not thinking to raise rates. So you keep piling on those political parts of the argument. I mean, it really is. This is as inflationary as it gets, in my view. And so it's almost impossible to really think about how can we have a deflationary bust, which a lot of deflationists like to say, because the market already knows what's coming after that. If we have 15% declining equity markets, what do you think it's going to happen? I mean, they're going to print more money. And so, market participants are fully aware of that. It's inflation that creates a limitation from central banks to do what most expect them to do, which is print money, that will create and unravel this more problematic kind of scenario with risky assets, in my view.
All right. Well, Tavi Costa, we really appreciate you sharing your insights today. And it seems like a crazy world that's out there, and it'll be great to kind of continue to monitor what's going on. And so if people would like to learn more about your website, where they can find you, where can they find you online, and any last thoughts you'd like to add?
Sure thing. Well, first of all, I just wanted to say that it is a crazy world, but there are a lot of opportunities. And for me, the biggest opportunities is buying gold and silver. It's not contrarian to buy gold, buy silver, buy Bitcoin. You walk on the streets, a lot of people agree with you. Now, what is contrarian to do is really go down or go up on the risk curve and go to the speculative sort of part of the industry of exploration and discovery kind of stories in the mining space of gold, silver, copper, platinum, and so forth, where no one can really navigate that space. And I think that's where the real opportunity is in the following years, especially those that have a mentality of long-term investments in the space. And I think that at least that's the way we're trying to accomplish here. In terms of our website, it is www.crescat.net. And you can also find my work on Twitter. I think my handle is @Tavi Costa. I also have an account on Instagram that I share the same sort of analysis there, and it's at Tavi Costa Macro. And we have a lot of letters, presentations that we do with companies that we have an activist approach with in the mining space and exploration and discovery, especially with Quentin Henney. And so, a lot of things going on, a lot of opportunities, even though, yes, you are absolutely right. It is a crazy world, but with a lot of things that we could do to profit from this. So thanks for having me.
Definitely. Once again, thank you so much, Tavi, and God bless.
Thank you.